Good morning, everyone out there. I have Rich Bonn today with Cross Country Mortgage, and I wanted to chat with him in regards to how the market is doing, what the mortgage industry is talking about. Has this COVID-19 changed the lending, and what are the guidelines that have changed? So I wanted to kind of let everyone know that hey, life goes on, and we're still making homeownership a reality, and we're still helping people get into a home. So Rich, good morning, sir. Tell them a little bit about yourself.
Well, good morning. A little bit about me. I've been doing mortgage lending, I think, since 1994. My career is old enough to drink. Um, Gosh, I've known you since what, 2008,
Nice.
2009, I think. My family and I, we live here in Southwest Houston, and my passion is helping make homeownership a reality, helping people achieve their dreams. But it's home ownership, not home buying, because you can buy a home and God forbid you lose it. Home ownership is being able to sustainably create a place where you and your family can form the bedrock of the community that you want your family to grow up in.
Exactly how we feel about it. That's good. Well, Rich, I wanted to really chat about the mortgage industry and how has COVID-19 changed the lending, requirements and the lending guidelines. Period.
Okay, I think that in order to really talk about this, we need to go back about 6 weeks. About 6 weeks ago, we started seeing interest rates plummet to the lowest levels I've seen in my career. And part of that was due to COVID-19. Part of that was due to the fact that there's so much economic instability around the world that
Right.
people were pouring all of their money into U.S. Treasuries and into mortgage-backed securities. That caused a precipitous drop in interest rates. And when it did that, a bunch of people wanted to refinance. Sounds like a great thing, doesn't it?
It does. It does. And I know that I had a fluctuation of calls from every consumer that I got into a home last month to my lenders are actually telling me, "Oh, hold up,
Yeah.
we can't take anymore." And that's when the rates really start shooting back up again.
Well, exactly. What happened is there's about just between 10 and 11 trillion dollars. That's with a T, trillion dollars in residential mortgage debt in the country.
Wow.
On an average month, mortgage lenders will do between 250 and 500 billion dollars in mortgages. The refinances alone that came in the last week of February through the first week and a half of March, that was $1.4 trillion in volume. That's just the refis. That's not even the purchases. It's amazing. But here's the thing. When you do that much business, you've got a capacity issue of where are all these mortgage bonds going to be sold? Because you've got buyers for $250 billion in the month, right? Or 500 billion.
Mm-hmm.
You don't have buyers for the 1.4 trillion. So that was our first challenge. The second challenge that came is that when lenders are buying mortgage loans, the people who send you your payment coupon every month, they're buying that expecting to service your loan for a couple of years, 3 to 5 years. And that's how they get paid, is because they make a small spread on your monthly payment. With all of these loans refinancing, and most of these loans that refinanced were done within the last year or two, the value of mortgage servicing was cut in half.
Nice.
Now, the mortgage lenders who are making these loans and who are sending you these coupons, they have borrowed money against the value of the mortgage servicing. The servicing rights are your collateral, or is their collateral for their loans. So when the collateral value dropped in half, all of a sudden they were getting margin calls. They were having to come up with extra cash in order to pay for funding these loans and in order to purchase more loans. So that started a liquidity crisis. The next thing is when you've got rates here and they drop to here, you know, like let's say you've got them at 4.5 and they drop to 3.25, like we saw last month. The mortgage lenders who are making your loan, when you've locked your interest rate, they do what's called a hedge. And they say, okay, we're gonna buy this money in the future so that we can satisfy that 4.5% loan. When the rates dropped to 3.5%, all of a sudden that hedge was not only worth nothing, it was worth negative money. The lenders started having to pay out for that. This is where a lot of the capacity issues were coming from. This created a huge liquidity crisis as well. Now the Fed started addressing some of this by buying mortgage-backed securities. The other thing that that they've done is that was affecting things was that they started talking about forbearances. And by the way, I want to apologize. My dogs also like to be.
It happens when you work from home.
It does.
I'm amazed that my kids are running around the office right now.
Yeah. We've got 3 dogs, and anytime a squirrel runs across the lawn or a blade of grass flickers, they're on it. They are on it.
Oh, amazing.
So what's happened is the bond investors are now worried that they're not going to get their income with these mortgage payment deferments. And Ginnie Mae and Freddie Mac and Fannie Mae, who are the 3 large bond issuers, have started working out a program for that. So we've got liquidity crunches everywhere. So that's the primary reason that people have started pulling back and adding overlays to the guidelines. Now, the bank statement loan market, that's gone because it doesn't go into any of those 3 servicers' bonds, and there's no place to sell them right now. A lot of the reason why people are pulling back on FHAs is FHA loans generally have a higher delinquency rate, and they're afraid that the FHA loans are going to go delinquent.
Makes sense.
So that's what's been going on. And so I've been watching as our competitors are saying, minimum 640 credit score or minimum 680 credit score. You have to have a 700 credit score with a 43% debt to income ratio in order to get an FHA loan. I'm like, well, man, why aren't you going conventional if you can do that?
Exactly. Yeah.
So you're seeing a lot of that out there. Thank God our company, we've added some restrictions as far as we want more reserves if your credit score is below, say, 620 or 640. But we're still doing loans down at 580 FHA.
It's amazing. So let me ask you a question, because I'm getting a lot of consumers right now. I think you're about to answer this, are freaking out because they're hearing that there aren't not going to be any FHA lending out there. I got other lenders talking about no more FHA lending, only conventional, and the world's coming to an end. So how has the mortgage guidelines changed ever since COVID-19 happened?
Okay, so the general guidelines for FHA, Fannie Mae, and Freddie Mac, they're set by those bond issuers. But each mortgage lender has the right to create what are called overlays and restrict or tighten up those guidelines. Lenders who are not in as great of a liquidity position, they don't have an outlet for the loans, they've been tightening up insanely. My mother lives out in California. She just finished a refinance with a buddy of mine who's a broker. And my buddy said, he was sweating bullets because a very, very large wholesaler had recently significantly increased the credit scores needed. They made their pricing completely unattractive, and they were doing everything they could to not do loans. Thank God we're a direct lender. We sell to Fannie, we sell to Freddie, we sell to Ginnie. So we're not really implementing those draconian overlays. Thank God we have the liquidity that enables us to be able to fund the government loans, the FHA loans, the VA loans, and we can put them into a bond and sell them on the secondary market. So we're doing great. Thank God.
Nice. That's amazing. Yes.
And that's actually one of the things today that's more important than ever, or actually more important than since 2008 and 2009, because we all know what happened back then, is you have to understand the strength, the experience, and the liquidity of your lender and what options they have. A couple of weeks ago, I was able to sell FHA loans to one of 60 different investors.
Amazing.
This week, the only thing we're doing is we're pooling them up and putting them in bonds ourselves because that market has dried up. So your third-party aggregators, the people who are buying loans on the secondary market, they really have slowed down. But because we have that direct pipeline into Ginnie Mae, where we can securitize our own loans, we still have the ability to fund them.
Perfect. Wow.
Does that answer that question?
That answered the question right on the dot, man. So guys, just to let you know, the world's not coming to an end. We're still making this a reality for everyone. Rich, how do we get a hold of you?
It's very easy. My cell number is 281-841-1723. And my website is richbonn.com. That's RICH, B like boy, O like Oscar, N like November, N like November.com.
Perfect. And I have one more question for you that one of my consumers actually asked. What is the interest rate versus annual percentage rate?
Oh my gosh, that's a great question that gives me such heartburn. The interest rate is how we calculate your interest and your monthly payment that goes out on your mortgage statement. The annual percentage rate is the amalgamation of the combination of the prepaid costs, like your prepaid interest, your prepaid insurances, et cetera, setting up your escrow account, plus your loan fees rolled into one, subtracted from your loan amount, and then they make up plus your mortgage insurance that you have to pay. Then they make up a hypothetical number. And the whole reason that the government did that was so I could have a gray beard.
There it is. So there's the question, guys, answered. If you have any other questions or any concerns in regards to how to purchase a home or questions in regards to obtaining a mortgage, period, that's what we're here for. My name is Gustavo Kwan, managing partner with G&M Realty & Associates. You can reach
Gustavo,
out.
I want to throw out one more thing before we close up. Okay. So there's been a lot of tell that we are fixing to start getting these stimulus, well, they call them checks, but they're actually stimulus direct deposits.
There you go. Can't wait to get mine, right?
Okay. Now, this is not called the Coach Purse direct deposit or the Michael Kors direct deposit or, the new fishing boat direct deposit. This is an amazing time. You're getting, in addition to your tax refund, you're going to get an additional $1,200, $2,400 or more come into your bank account. Now, there's two things you can do. One thing that you can do is you can take that money and you can go spend it on all sorts of stuff that's not going to get you into a new house.
Exactly.
Or what you could do is you could be smart, take that money, put it into a savings account. When your tax refund gets in there, put it into that savings account. Get in touch with Gustavo, get in touch with me. And what we'll do is we're going to help you use that money to make a down payment and get into your home.
Perfect. So let me ask you another question. How much down payment is required to actually purchase a home?
Depending on your situation, for example, if you're a U.S. veteran, number one, thank you for your service. Number two, $0. Nothing.
Amazing.
Nothing. If you haven't served, we could do things for as little as 3.5% down, unless you're in some very special areas. On a $200,000 house, that's $7,000. That ain't that much. I mean, okay, so a family of 4 is going to get $2,400 from the stimulus plus an extra $500 for a kid. Okay, so we're looking at $3,400 right there. That's half your down payment.
Amazing.
And then when you get your tax return, your tax refund, how much is that going to be? That could be the rest of your down payment. So don't sit there at home on Amazon Prime ordering stuff that's not going to get here for 3 or 4 weeks. Put that money to the side and get yourself into a house in 3 or 4 weeks. It seems like a no-brainer to me.
No brainer whatsoever. And just a reminder to every consumer out there, guys, just remember, I work with tons of new home builders. I work with a lot of scenarios where if you don't really have the closing costs, we can make that a reality and help out as well. So in some areas, you don't really need that much money, period. Just a reminder out there. And all it takes is a phone call. Don't let the fear of, oh, I can't get into a home, or, oh, I got bad credit. And just another reminder, don't forget that we are affiliated with G&M Credit Solutions, which is our credit repair side. We provide 100% free credit repair to any consumer that's looking to get into a home, period. So we'll help you to not only meet the underwriting guidelines, but maximize your scores to get you into a home, period.
I want to share one story based on the fear thing real quick. Last, I think it was the day after Christmas, I had this young lady call me. She called me. She's like, I'm calling you. There's no way I'm going to be able to afford or be able to qualify for a house. But my father, who used you a couple of years ago, keeps telling me to call you. So I'm calling you to get my dad off my back. So we talked, ran her credit. We looked at her documents. I'm like, what are you afraid of? You're done, easy. We're getting you into a house. She's like, what do you mean? She's like, I don't have great credit. She had a 650 score. She's like, I don't have 20% down. You don't need 20% down. We were able to get this woman into a home. Do not qualify yourself out of being able to buy something. Let Gustavo, let me work with you. Because even if we can't say yes right now, we can show you how to get to yes very soon.
As I always say, Rich, it's not a no. It's just not a right now. We just need to put that map together to make homeownership a reality. And that's period.
Absolutely.
And I agree with you 100%. The biggest challenge that a lot of my consumers have of not getting to a home is the fear of being rejected. And even though we don't have the scenario that to get you a pre-approval, I will work with you guys to the end to help you to minimize your debt to income ratio, to help you to maximize your credit scores, to provide a roadmap for you guys to get into a home. So don't let that stop you. But the first step is to talking to somebody like Rich, talking with somebody like myself, so that way we can understand your scenario and we can help you from there.
That's absolutely it. It was wonderful to spend a little bit of time with you. We need to do this more often because
we do, Rich. I appreciate
some really great stuff.
Right. And again, how do they get a hold of you, Rich?
281-841-1723. That's my cell number.
How easy is to apply?
Yeah, it's simple. Just go to richbonn.com. And can you link that in the comments below to this?
I will.
Okay, go there. There's an apply now button. And what's really cool is for a lot of people, we can even do their verification of income and their verification of assets so that I just get your documents and go, hey, I need you to send me these 3 things. Boom, you're approved.
That's how easy it is. It just takes one call, one action for us to get you into a home, guys. And again, don't let that fear of, well, I can't do it. Let us put that map together for you guys. Thanks a lot, Rich. It was very, very awesome talking with you, man. Again, my name is Gustavo Kwan, Managing Partner with G&M Realty & Associates. You can reach out to me with any questions at 832-612-1091. And you can always call Rich at
281-841-1723.
Perfect.